What's up everyone, it's Pablo here and welcome back to the channel. Today we're diving into the world of finance and tackling a crucial document, the income statement. Whether you're a seasoned investor or just starting your financial journey, understanding income statements is key to making informed decisions. We're going to break down the top 10 tips for analyzing income statements like a pro in 2024. If you want to master your financial analysis skills, make sure to stick around till the end. Let's get started. First things first, we need to lay a solid foundation. An income statement, also known as a profit and loss statement, is a snapshot of a company's financial performance over a specific period. It shows you how much money a company brought in, revenue, and how much it spent, expenses, to generate that revenue. Think of it like tracking your own personal finances. The basic structure of an income statement is straightforward. It starts with revenue at the top, then subtracts the cost of goods sold, COGS, to give you the gross profit. From there, it deducts operating expenses to arrive at operating income. After that, you factor in non-operating items like interest income or expenses. Finally, you subtract taxes to get the net income, the bottom line. Now that we understand the basics, let's dive into some analysis techniques. One of the first things I look at is the revenue trend. Revenue is the lifeblood of any business, so you want to see if it's growing, stagnant, or declining. Is the company growing its revenue year over year? If so, at what rate? Is the growth accelerating or decelerating? Ideally, you want to see consistent revenue growth over time. Keep in mind that revenue growth alone doesn't tell the whole story. Consider the industry and economic conditions. By analyzing revenue trends, you can gain insights into the company's future potential and whether it's on a sustainable growth path. Next up, let's talk about the cost of goods sold, or COGS. This represents the direct costs associated with producing the goods or services that a company sells. Analyzing COGS is essential because it directly impacts a company's gross profit. A higher COGS means lower gross profit and vice versa. When looking at COGS, pay attention to its relationship with revenue. Is COGS increasing at a faster rate than revenue? If so, that could be a red flag. Understanding COGS and its relationship to revenue is crucial in evaluating a company's profitability. Now let's move on to gross profit margin, a key profitability metric. Gross profit margin is calculated by dividing gross profit by revenue. It tells you how much profit a company makes for every dollar of revenue after accounting for COGS. A higher gross profit margin is generally better. However, gross profit margins can vary significantly across industries. Therefore, compare a company's gross profit margin to its industry peers. Analyzing gross profit margin gives you valuable insights into a company's pricing power, efficiency, and overall profitability. Moving down the income statement, we come to operating expenses. These are the expenses incurred in running the day-to-day operations of the business. Operating expenses can be broken down into several categories, including selling, general and administrative expenses, research and development, and marketing and advertising. Each category provides insights into different aspects of the business. When analyzing operating expenses, look at their proportion to revenue. Are operating expenses increasing at a faster rate than revenue? If so, it could indicate inefficiency. Compare a company's operating expenses to those of its competitors. Companies with lower operating expenses as a percentage of revenue are generally more efficient. After deducting operating expenses from gross profit, we arrive at operating income. Operating income represents the profit from core business operations before interest and taxes. Analyzing operating income is crucial because it provides a clear picture of the profitability of a company's core business. A healthy operating income indicates effective cost management and profit generation. Look for trends over time. Is operating income growing, stable, or declining? Compare a company's operating income to its historical performance and industry peers. By analyzing operating income, you can understand the underlying profitability and sustainability of a company's business model. Now let's move on to non-operating items. These are items on the income statement not related to the company's core business operations. Examples include interest income, interest expense, and one-time charges or gains. While non-operating items may not reflect day-to-day operations, they can impact net income. Understand their nature and whether they are recurring or one-time events. Carefully scrutinize non-operating items to understand their potential impact on the company's overall financial picture. Finally, we arrive at the bottom line: net income. Net income represents the company's total profit after deducting all expenses and taxes. When analyzing net income, look for trends over time. Is net income growing, stable, or declining? This can signal challenges in overall profitability. Compare a company's net income to its historical performance and industry peers. Net income is a crucial metric for investors and analysts, indicating a company's profitability and ability to generate value for shareholders. Now let's talk about earnings per share, or EPS. EPS takes net income and divides it by the weighted average number of shares outstanding. It represents the portion of a company's profit allocated to each outstanding share of common stock. A higher EPS generally indicates higher profitability. When analyzing EPS, consider both its absolute value and its trend over time. Analyze EPS in conjunction with other financial metrics to understand the factors driving its performance. One effective way to analyze an income statement is to compare a company's performance year over year. This involves comparing the current period's income statement to the same period in the prior year. By comparing year-over-year performance, you can identify trends in revenue, expenses, and profitability. Consider any significant events or changes that may have occurred during the period. Calculate year-over-year growth rates for key income statement items. By analyzing year-over-year performance, you can gain valuable insights into the company's financial health. That wraps up our top 10 tips for analyzing income statements like a pro. Understanding a company's financials, especially the income statement, is like having X-ray vision into its financial health. Thanks for watching. If you found these tips helpful, don't forget to like, comment, and subscribe for more financial insights. Your support means the world and helps the channel grow. Check out the link in the description for a detailed blog post on this topic. See you in the next video.